Today, Graham Stephan is going on about how the Fed just reset the market. Is it the Great Reset, or is it just a reset? I guess Graham has a lot to say on this, as he usually does about a lot of things when it comes to the market. Smart guy. Some of the things he's gone on about, though, not too sure. Anyways, I'm going to go through this with you, and I'll give you my thoughts on things while we look at whether this is just a reset or a great reset that's taking place. Let's check it out.
What's up, Graham? It's Guys here. So we've just had a major announcement from the Federal Reserve that changes everything. And with only 2 more weeks until their final rate hike of 2022, you're going to want to hear this out. After all, we've already just seen their fastest rate hike in history. But housing prices are slowly increasing. Goldman Sachs believes that oil might continue surging higher. And China's lockdown protests are becoming a pivotal moment for the entire world. That's why, if you're curious why the market's about to have a potential freak out, it's important to discuss exactly what's going on, the chances of a larger than expected rate hike in just 14 days from today, and which signals have historically pointed to the bottom of the stock market on this episode of The IRS is Always Watching. Especially if you make $600. All right, so first we have to talk about the next rate hike that's coming up very soon on December 14th, because this is quickly becoming one of the most anticipated meetings of the entire year. That's because the Federal Reserve has a near direct impact on the value of almost everything, from stocks to bonds to real estate, and even the amount that you get paid in a savings account. So here's how that works. On the most basic level, the Federal Reserve is what's known as a central bank, whose role is to oversee our economy, regulate financial institutions, and control the amount of money that goes into and out of our system. All right,
hold it right there. So Graham is getting started on going over what's happening, and he's talking about the central bank. And he is, of course, talking about what they're supposed to do: oversee the economy, regulate the banks, control the money. So as you know, being in the crypto space as we are, we know what this has led to, and we see what's going on in the world today. Do you really think that central bank and the changes they're making are going to help with this situation? It's really hard to tell. So far, we can see that there's lots of problems that are going on in the world, as Graham alluded to in the beginning of the video. And of course, there is a lot of bad things happening. And I would say it actually all goes back to the central bank and what's happening with the money supply. And frankly, is it going to get better? We are looking at the possibility that they're going to slow down with these rate hikes. We'll see. It's hard to tell. Graham seems to think that it's going to be basically the same old, but we'll see. Anyways, I just want to bring up the fact that these are the guys, the ones we're talking about now are the same ones we've talked about in multiple videos. The fact that they're the ones that control the money, they're the ones that decide how all this stuff plays out. Most of us, you know, that go about our daily lives have no idea that this is happening. We just kind of go about, you know, we make our paychecks, we buy our things, and we live our lives. Meanwhile, these guys are playing God, so to speak, with how your money is going to work. And yeah, we've seen how disastrous those effects are. Do we want to continue to have people like this in charge of it? Or do we want to have something which everybody has the same rules that they have to play by, and nobody like this can be able to mess around with those rules? That's what Bitcoin is. That's what crypto promises, and certainly is a better system for going forward, which is why you should be thinking about that right now. Anyways, let's keep going and see what Graham has to say about all this.
Money that goes into and out of our system. Their priority over everything else is just to make sure that the U.S. has a strong labor market, maintains maximum levels of employment, and operates in such a way that moves us away from record high inflation. I guess more simply put, they just want to balance growth with making sure the price of eggs doesn't hit $5 a dozen. So as a way to do that, they decide whether or not they want to raise or lower what's called the federal funds rate, which is just a really fancy way of saying this is the interest rate that banks charge other banks anytime they lend each other money. When this rate increases, then lending becomes more expensive, people and businesses have less discretionary income, and the economy gradually slows down. Whereas if the interest rate decreases, you get stock market experts, Dogecoin millionaires, and trading halts. So a lot rides on what they decide to do in just another 2 weeks. In fact, this is going to be the last rate hike through February of 2023. And in terms of what they've already indicated, along with what's happening happening throughout stocks, bonds, and real estate, here's what you need to know and the warning for what's soon about to come. To start, let's talk about the stock market, because this is where things get interesting. Now, on the most basic level, as interest rates increase, stocks generally decline because higher borrowing costs eats away at the value of future cash flow, and as a result, they fall. On top of that, the higher rates go, the more bond yields increase, and the less appealing everything else looks as an investment. After all, why take the risk in stocks when you could get a one-year government bond that pays you close to 5% with almost no risk whatsoever? But in terms of just how much this affects stocks,
stop right
here's
there.
what I found.
Yeah, so just a little note about that fact about bonds. So those kind of rates weren't available up until recently. So that's the situation as of now. But for the longest time, with this big run-up that we've had with the way that interest was set, yeah, that they weren't able to see that. So that's why stocks got so overpumped. Yeah. So that's a little bit of background in terms of what he's talking about with the stocks, is that the interest rate on bonds was not crazy like that in comparison to what you can make on stocks. So let's keep going.
Surprising. A recent study broke down investors into two categories. One considered the choice between a risk-free return at 5% or a risky return of 10%, while the second group made the choice between a risk-free return of 1% or a risky return of 6%. In both of the scenarios, the risky investment pays the exact same 5% more, but the results were vastly different. It was found that the low risk-free returns caused significantly more risk-taking for higher-yielding investments, even though technically the difference in payout was the exact same. Those findings began to normalize once risk-free interest rates are higher, even when the riskier investments still pay the exact same amount more. Basically, the conclusion they found was this: when risky investments pay substantially more than the risk-free return, investors are more likely to go for it. In this case, the difference between going from 5 to 10% is double, but going from 1 to 6% is a 5-time higher return. So when viewed in proportion, the riskier investment seems like the way better option when your other alternatives are paying you pretty much nothing. But the implication for today is that as interest rates go up, investors won't need to take as much risk throughout other assets like stocks, real estate, or even cryptocurrency. And as a result, the market will likely decline as people move towards these safer, guaranteed investments. Housing prices are also a prime example.
Right there. Yeah, so he keeps talking about risk-free investments. So he's talking about bonds and government bonds and whatnot. Don't know if you've looked around lately, but our institutions are in pretty bad shape. The idea that even those are risk-free, the rate of interest that they're offering on them is a good indicator of the fact that they're not. I think that the assumption he's having is really based on the classical model of what we've understood in the past. We are not in the same place as far as what's going on with the economy. We are in uncharted territory. Everything he talks about in terms of like historically this and, risk-free that, doesn't apply anymore. So he's talking from a playbook that's about, rules that used to work. That playbook's gone. We're in a totally new game and we don't even know what the rules are now. So I think that you have to be careful about understanding things in the frame that he's talking about here, because the truth is nobody understands what's going on right now. Nobody knows where we're going, and history is not repeating itself. We are in a completely new place. So you have to be careful with the assumption that Graham's making here. That's all. Yeah, so he's about to talk about what's going on with the housing market. So let's keep going.
This, and it's happening right now. Apollo Research found that we're currently seeing the fastest real estate slowdown on record in terms of home sales, and Bank of America CEO believes that we're in for another 2 years of paying for the housing market. I think it's no surprise that throughout most of the country, it's simply an effect of supply and demand. And if buyers no longer have the purchasing power they once did, then either sellers will have to keep their home on the market for longer or reduce it to a price that someone is willing to pay. And that's what we're beginning to see. In this case, values have fallen an average of 1% in September. Nearly 30% of sellers have cut their price. And fun fact, but Thursdays are the most common day for a price reduction. The more you know. Anyway, the general sentiment indicates that the housing market is likely going to continue slowing down throughout 2023. And in terms of how the Federal Reserve is responding, there are a few factors that are beginning to work against them. And no, it's not robot landlords who are buying up houses. Instead, we have number one, China's protests. Initially, this began from a zero-COVID policy where lockdowns and tight regulation were strictly enforced. This resulted in delayed manufacturing and production, higher costs, and in return, higher inflation here in the United States. However, many of their citizens have begun to protest these restrictions, and even though it's too early to tell how this is going to play out,
Hold on a second. Did he just blame the Chinese protests and the delays in manufacturing on the inflation in the United States? What? That's not right. Yeah, Graham, don't know what you're trying to say here. That sounds like some kind of like mass media kind of a talker point. That had nothing to do with the inflation in the United States. So the inflation was caused by the central banks. And the fact that what's going on in China wasn't the cause of the inflation at all. But he just said that. So I disagree on that point. You have to understand that the inflation is completely at the fault of the central banks. They are the ones that control it. They're the ones that control the money supply. They're the ones that are making these decisions about whether they're going to increase rates or be able to do all kinds of crazy things. But what's happening with China basically is a supply issue with the COVID lockdowns that they're talking about. Yeah, that's caused a supply issue. That is correct. But that doesn't mean that that's what caused inflation at all. If anything, that would be a deflationary effect. But yeah, I don't know why Graham would pop that in there. Maybe it was just a mistake. Anyways, let's keep going and see what all this about China protests he thinks has to do with it.
Standpoint, the additional uncertainty is leading to a decline across markets, and some investors believe that this could also lead to an increase in inflation. Now, second, we have oil prices. This metric has an extremely close correlation with our inflation rate, because the higher oil prices go, the more expensive it is to ship, manufacture, and produce our items. For instance, if the cost of oil goes up by 10%, all of a sudden your trips become more expensive, your grocery items cost a little bit more to deliver, your Amazon packages cost a little bit more to produce, and that in turn scares Jerome Powell to raise rates even more. Now, despite oil having come down slightly from its record high, prices are still 50% higher than they were a year ago. And with the chance of a supply cut, prices might continue to remain high for longer than we think. And that could cause the Federal Reserve to keep their interest rates higher for longer. And third, we have housing.
Hold on right there. So before we get into the housing part, he just talked about oil and he talked about the inflation again. But the prices he talked about, even with the all-time highs, are coming down and they're still 50% from last year. That is after a ton of money got printed by the central bank and actually caused everything to inflate. It didn't have to do with the oil prices specifically. Yeah, I'm not sure why he would tie it to that. I understand that there's some people out there who would make that a talking point, but that's not where the inflation's coming from. Oil prices are higher. I understand what he said about how that impacts all the prices of everything. He is absolutely correct about that. But the reason that the price of oil went up is because the money printer went up. The money printer went brrr, and of course we had so much money get dumped into the market that of course goes down to everything else, and of course the oil prices would go up because of that. So I don't agree with this point that that's the Chinese protests are what's causing inflation, and oil prices are causing inflation, and then that is when the Fed is going to respond and actually like increase rates and things like that. It's not. It's because there is so much money swimming in the system, just swimming, that they're trying to be able to keep it under, like they're trying to keep control of it from going into basically hyperinflation, which is what we're teetering on. And they're just like pulling these levers to try to keep it from going there. So yeah, housing costs. I guess we'll get into that and see what that's all about. But I hope he doesn't say that the housing costs are because inflation. We'll see. Let's go.
Basic level, shelter makes up a third of the overall inflation report. And even though rental growth is slowing down, most landlords have indicated that they intend to continue raising their rates, albeit at a slower pace than before. Now, obviously, rental growth is measured on a month-over-month and year-over-year basis, so eventually prices are going to begin to level out. But in the short term, the Federal Reserve may choose to wait until this happens, and that could be anybody's guess. So in terms of their latest strategy and what they've indicated is most likely going to happen, here's what you need to be made aware of. See, 2 weeks after every policy meeting, the Federal Reserve releases a detailed record of their discussion in what's known as the Fed Minutes. This gives us a lot of insight into their stance on monetary policy,
every 2 weeks,
rate hikes, and the expectations for the near future. And the most recent report gave us a lot of juicy details. To start, they admitted that the most recent inflation report provided very few signs that inflation pressures were abating, implying that they'll have to probably keep rates higher for longer than expected. However, it was also noted that a substantial majority of participants judged that a slowing in the pace of increase would likely soon be appropriate. And this soon is giving a lot of investors hope that this would happen in their next meeting, December 14th. If this occurs, it would be the first sign of what's called the Federal Reserve pivot, where they reverse the rate hike tightening cycle that was started at the beginning of the year. And that would probably lead to a huge boost throughout the stock market and throughout almost everything. So what's the chance of this happening? Well, if you ask investors, they're pricing in a 67% chance of a 50 basis point rate hike in another 2 weeks, with a 33% chance of a 75 basis point rate hike, just like we've seen throughout the last few months. But ultimately, all of this will depend on the latest inflation report, which is going to be released a day prior on December 13th. Because of that, I think it's pretty safe to say that if inflation comes in below expectations, most likely the market's going to rally through the beginning of 2023. But if it comes in higher than expectations, then probably all bets are off, and most likely we're going to see a pretty quick sell-off through the end of the year and maybe even a little bit longer.
Stop right there. So he's going on about how the markets are going to respond to the Fed minutes and whether it's going to be a rate increase that's going to be higher than expected or lower and all this kind of stuff. And if it's lower, then it means that, okay, they're easing up, and then the markets are going to go boom. You know, there was a time long ago when the Fed operated independent of the markets. The markets didn't just respond to how much the money printer was going to work. This is completely broken. Like, you got to understand, the system is so broken, and they're pulling these levers on something that isn't even working anymore. Like, I can't get all into all the details about it, but the fact is that we have markets that are not even markets anymore. They simply turn on whenever the Fed is going to print more money to be able to pump it up. It's almost like the intrinsic value of whatever the market is just doesn't matter anymore. It's almost like they're just picking and choosing their favorites. They're betting on the horse that they like, and then they're pumping all the money into those, and only if they're going to be able to get cheap money and do that. It's really pretty disappointing. That's what's happening at a higher level. I just don't think that you can't really, again, we're in uncharted territory. We are in a place that nobody has seen before. So as much as Graham wants to talk about this as though he's understanding, you know, this is what's going to happen, that's what's going to happen, he prefaces everything with maybe this, maybe that, you know, it could go this way, it could go that way, because he doesn't know. As confident as he sounds, he has no clue. Neither does anybody else. So at the end of the day, I mean, all you can really take away from what Graham's talking about is nobody knows. There's this, you know, everybody's betting on how much the rate's going to go up or down. And based on that, there's going to be a market movement. Nobody's even considering the fundamentals of the market anymore. What's that, right? Do you really want to try to play in a marketplace like that? No, of course not, because you have no clue what's going to happen. It's crazy. It's just crazy. Anyways, let's see if Graham has anything more to say. Is this a great reset? So far, yeah, not really. But let's continue.
As far as when we could see the stock market bottom and which signals we have to look out for to see just how well or how bad your portfolio will do, here's a few things to consider. Now, at a first glance, in terms of a market bottom, it's no surprise that right now we have what's called an inverted yield curve, which has correctly predicted 9 recessions since 1955. And on top of that, the yield curve is the most inverted it's been.
Hold it right there. Since... Oh, here we go again. We're looking at the history. And that history indicates, yeah, we're in deep doo-doo like never before. So again, you know, you can look at like how bad it got in some instances. You could see when we had the 2008 crash, and of course, right there, actually the worst one just before us is the dot-com bubble. But yeah, our chart now is tremendously more worse. And why? Because we basically printed 100 years of dollars inside of a couple of years. Right? Like literally just double the amount of cash that's out there inside of a few years, which never happened before in history. Again, look at that. Never happened before. Why are we looking at charts like this and trying to say, well, this is what's happened historically, and you know, it means that this should happen next? You can't, because we are so far off the charts at this stage. You can't even start to think that way. You have to think, this is uncharted territory. I better start thinking a different strategy. It's my take anyway. Anyways, Graham seems to think that you can look back and then be able to see the future. We'll see who's right. Let's keep going.
1999, right before the dot-com crash. This occurs when short-term yields begin paying more than long-term yields. Therefore, they invert, signaling that investors see more risk investing in the short term than they do in the long term. Even more severe is that we're currently 100% inverted, where every term is paying more than the 30 years. So as far as where we go from here, if we look all the way back to the 1960s, we could see that when the 3-month 10-year yield inverts for more than 10 days, it took an average of 311 days to actually enter a recession. recession. And once in a recession, it lasts for an average of 17.5 months. Now, it's no surprise the yield
go all the way
curve
back to
has
the
already
60s to
been
get that.
inverted for most of this year, which means that, yeah, something has to give. But in terms of this equating to a stock market bottom, Morgan Stanley says that generally speaking, we don't see bear market bottoms without panic selling, similar to what was seen in 2001 and 2020. Historically, no bear market has ever bottomed without a VIX reading of 45 or more, and sure enough, in recent history, that's been true. However, I will say that from my own experience, nothing happens exactly as you think it will, and all of these historical trends will be true until the one time they're not. That's why dollar cost averaging into index funds. Okay, jokes aside, I have a feeling that a lot is going to be revealed in their upcoming meeting in December, and hopefully we're going to be at the upper end of where interest rates might settle. Until then, I would expect to see a lot more volatility, and I'd also be curious to see what you think about all of this and whether or not you see prices coming down in your area. If you feel like there are and inflation is coming down, then you're a part of the 2/3 of investors who think that December is going to be the moment the Fed takes the pedal off the gas.
Okay, so are you amongst the people who thinks the rate's going to go up even more or is going to go lower? Who cares? This is, I mean, at the end of the day, the last thing he had to say was, well, historically we see this until that one time that it doesn't happen, you know, that's when it happens. And of course, we are in a place where this is the one time, okay? And you got to keep in mind that we're in a situation that is nothing like history. So don't go making your choices based on the history of the markets and the way that they're working now. It's a bad idea. Use your good sense, you know, start to take in more info than guys like Graham and think about what kind of future you want to build. Think about where you are as far as like everything is concerned and what is your counterparty risk to all these systems, right? Because you got the money printers going burr, you got the stock markets just flapping it up every time the rate goes down. So it's not even about market fundamentals anymore. Where do you want to be? What kind of future do you want to build for your children? That's, I think, what we need to focus on. But anyways, I disagree with some of what Graham was trying to put across as the causes of inflation. These were just consequences of inflation. They weren't the cause. I don't think this is the Great Reset. I think this is a bit of a reset to what they were doing, but it's just a tiny little bump. And of course, we're going to see the markets move and this and that. But at the end of the day, we are still in uncharted territory, and it's almost like watching a dead man walking. Like they just haven't fallen over yet. So it's scary. So whatever you do, stay strong and understand that this is the way the traditional system works. And of course, in the crypto world, we're all about transparency. It's all about being able to build a better future that doesn't play all these games, right? And of course, that's what a lot of us want. So let's focus on that. And of course, if you have a different opinion, please share it in the comments. I'd be happy to see it. Like and subscribe as always, and I'll see you in the next one.